Hello there, people of the internet. Welcome to another video. In this video, I'm just gonna be teaching you guys finance. Okay, literally just finance. I have a proper order this time, so yes, let's get started. Of course, you can take a look at this. I'm not gonna go through specific details. So think of it like this. Okay, you have 1 plus r times the number of years. I call it times, but it's actually to the power. Okay, and then you have future present value. Okay, times 1 plus r times n, which is actually the future value. Now, do future value over 1 plus r times n. So 1 by r times n, and that you get the present value. Okay, simple. Now, let's move on to the next thing. WACC. This is the weighted average cost of capital. Okay, this means how much is a company spending on equity, assets and debt. Okay, so assets is, things that make them money. Debt is what takes money away from them, something they owe, right? Liability, the equity, assets and liabilities, right? So weighted average cost of capital is what a company spends on assets and debt to keep its finances running, right? Next we have CAPM, okay, capital asset pricing model. Now this is a risk to reward 1 to 3, right? So this is basically for investments. Okay, so think PE ratio, okay, price to earnings ratio. Now this is the share price. So share price is what we're really talking about here. Share price over how much do you make, okay, per share. Okay, so let's say you put a $10 in a $100 stock. Let's say $100 stock, $100 per share. You put $10 in that share. Okay, so how much do you make when the price of this goes up, right? As a ratio, right? 1.5 like that. So what else? So we have systematic requirers, yeah. So that should do. So these two just have initial investment for first. So let's say, for example, discounted cash flow. Okay, it also uses 1 plus r to the power n. So think of it like 1 plus r times n. Okay, and we have discount cash flow 1. So I'm just gonna say n, but this is the number of years. Okay, so this is actually the discounted cash flow. Now the other the NPV and IRR, which is a net present value, which is a total value of the total present value of the company. Net means total. Okay, gross means per product or service. Okay, per item. Okay, per item. Gross means per item, and then net means total. Okay, total. So now net present value means the total present value of a company. Now total, by total I mean after spending on like EBITDA. Okay, which means earnings before, earnings after spending it on weighted average cost of capital. Now I'll get back to this part. So gross, gross, my bad. So NPV. So NPV is actually, so the difference between this discounted cash flow and the discounted cash flow and NPV and IRR is that there's an initial investment coming in for NPV and IRR. Okay, so there's an initial investment. So we call it like, I think C0, which is the initial investment plus this. Okay, so then it keeps repeating on the 1 plus r times n over the CC, like the cash flow for the years over the 1 plus r times n. Okay, so the initial investment applies to a few of them, like internal rate of return, net present value, which is the total present value of a company. There's also like simple calculations, like let's say return on investment, okay, ROI. So that's like how much you made as profit. So it's a profit. So let's say 1 second, guys. Yeah. All right, guys, I'm back. So basically, return on investment is like how much you gain from your investment. Okay, so let's say this is my R. Okay, so like R, let's say R plus 5. Okay, that's like my gain. So that's R plus 5 over what I invested times, that is like risk. Okay, risk plus 5, that means you gain something, times 100. Okay, that's like as a percentage, ROI percentage. If it's a 70% return on investment, so on and so forth. Okay, so yeah, that's pretty much return on investment. Let's move on to market capitalization. So so let me explain something. Okay, enterprise value is like how much a company is valued. Okay, so think like market cap. Okay, market cap. Don't worry, I'll explain what this is. Plus debt. Okay, debt minus cash. Okay, cash is money. Okay, let's say I don't know how to. I can't be asked to like write all this. So cash. Okay. So this is enterprise value. Now, apart from this, we have the market capitalization, which is this one, right? So market capitalization is made as the share price, okay, price of share, price of, let's say price of share, times the total number of outstanding holders, okay? Total number of outstanding holders, Okay, so outstanding, let me explain what this is. Outstanding is private and public. Okay, that means internal company. Now public is of course like what goes as an IPO, initial public offering. So that's when it's listed on the stock market, okay, share market, for the public to invest in. Now there's a private side of it, which is like sometimes private equity companies, if you have heard of that. Those firms get access to this private side of it, the private side of the equity, right, which is acquiring a certain percentage of a company that's outside of the public's reach. Okay, so let's move on. So this is the market capitalization. Okay, that applies in this enterprise value equation as well. Now, two important things you guys need to know is enterprise value. So there's this thing called a comparable analysis. Okay, comparable analysis is nothing but comparing and analyzing different companies together. Okay, so there's like a buyers. Let me show you guys like a comparable analysis. So let me show you guys this chart. Okay, this one is a pretty good chart. Oopsie, I just close that. All right, so first of all, as you can see, we have the buyer, and we don't really have the buyer inside, but what you need to know here is TEV is actually the same thing as EV. Okay, that's the total enterprise value. Okay, it's the same thing. I've explained what the formula for that is. That's this one. Okay, TEV, total price and total enterprise value. Okay, so now what you want to do is, you see over here we have, let me show you guys. So let me have so we have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Earnings before interest and taxes right here. Okay, so over here you see like how EV over sales, EV over EBITDA, like that and so forth, right? So from here we calculate a ratio of average, what sort of return it got, versus what sort of median average, what sort of middle average you got, right? So pretty much let me show you guys something. So I think I've explained how the market capitalization works, which is market cap right here, and then total enterprise value, that's basically this one, as you can see, and EBIT and EBITDA. So this is before interest and taxes, and this is before interest, taxes, depreciation and amortization. So you can see the depreciation and amortization from the difference in these two, and so on and so forth. You can see the rest of it as well, right? So you can see the market capitalization. So let me show you guys. That's the times outside, like the share price times the total outstanding shares, right? So let me show you guys something else. So apart from this, so let's go back to the slides. So again, capital asset pricing model is just risk to reward, like 1 to 3. Like if I'm risking $50, I'm going to make 130 from it. That's a 1 to 3, right? I'm 150 from it. Okay, that's a 1 to 3. So like that, what's the risk to reward I'm going to get? That's the capital asset pricing model. Okay, relative risk to return. Okay, so NPV, future value. This has the one initial investment, which is the net present value. I think I've drawn that somewhere here. Yeah, so net present value, which contains this one. So IRR and NPV both contain the initial investment. That's what C0 means. Okay, so cost zero, like initial investment in something. Okay, so let's move on. So again, cash flow statement. So I've shown you guys the comparable analysis. This is called a precedent transaction and analysis sheet. Okay, so this is based off previous data. Okay, you're analyzing a company based off previous data when you're considering, I'll give you an important terminology, mergers and acquisitions. Okay, merging is combining. Okay, the obvious common sense, right? Acquiring is buying. Okay, buying another company. Now when you're buying another company, you can't just buy it. You need to use another person's you need to use debt in most cases. This is called leveraged buyout. Okay, leveraged buyout is basically when you spend, let's say you go to the bank. Okay, you go to the bank, you give $2 million as collateral. Okay, which means you're saying $2 million you give for a $10 million debt. Okay, so once you get this $10 million debt, what you do is you fire people and stuff, and then you increase the value of the company, and then you eventually sell it out. But the point is, you buy it, like you leveraged buyout. Okay, which means you get a debt to buy this other company in acquisitions. Okay, so apart from that, or even in mergers, you get a certain equity, right, in another company. In that case, whatever party is interested in merging will spend money by LBO, which means getting debt. Okay, leveraging debt, leveraged buyout, which means by getting debt and buying out. Okay, so yeah, so what else do we have? Cash flows, balance sheets. So balance sheets, there's payable. Okay, payable and receivable. Okay, accounts receivable and payable. This is part of accounts. Receivable means you get money, you're supposed to be receiving money, and payable means you're supposed to give money away, as in you need to pay for it, right? Something like debt, for example, is accounts payable. You need to pay these accounts. Receivable is you need to receive money for this account. So apart from that, I've explained what gross and net is, right? Gross is individual price or service, like the margin in the individual price or service, and then what was the other one? Net is the total value after you spend it on whatever that needs to be spent, like whether it's debt or spending on assets. For example, when it comes to like the CA or the weighted average cost of capital, it's all about how you need to spend on assets and liabilities in order to keep the company's finances intact. Okay, so to avoid any other issues, you keep it going. So asset turnover, inventory turnover, I'll put this in the discussion. So it says return on equity and return on assets. Okay, I think it's quite obvious what assets and liabilities are. It's like what makes you money versus what takes money away from you. Cash flow, balance sheet, profitability, right? I'll get back to this part as well. So net present value ARR, I've taught you guys about this. Weighted average cost of capital. Payback, I've taught you guys about this as well. That's accounts payable. Debt versus equity, I've taught you guys about this as well. Dividend policy, yeah, that's fine. Dividend is basically like something that's supposed to pay you away. So it's this thing called perpetuity. Okay, perpetuity. So that's when like you're supposed to be receiving a guaranteed reward. Okay, that's when you're supposed to be receiving a guaranteed reward. Okay, reward. So this happening forever is called I got this definition wrong. Hold on. So perpetuity. So right here you can see that annuity is annuity guarantees a return. Okay, reward. So reward, annuity guarantees that, but perpetuity is the one that guarantees that it lasts forever. Okay, perpetuity guarantees that it lasts forever. So forever, that's annuity. That's perpetuity. Okay, forever, perpetuity, and the annuity is the reward. Okay, it's you're guaranteed to get this reward. So guaranteed reward. Okay, what else do we have? So we have guaranteed reward. What else? Net present value, internal rate of return. I've explained these stuff as well to you guys. Weighted average cost of capital, working capital management. Dividend policy is like dividend is like how much you receive, right? So like how much the shareholders of a certain company receives on a receives as a return of the investment, right? So what else do we have? Asset classes, so stocks, bonds, it's government bonds, real estate, crypto. Stocks is like the usual share market. So keep in mind, stocks are done in this form. Okay, so investment banking, what they do is they have the company, right? Company A comes to you. Okay, comes to you. You're the investment bank. These guys help this company raise funds or go out on the stock exchange or raise funds or overall increase the value of this company A, and then either get merged or acquired by another company. In other words, find investments. Okay, find investors. So it connects company A with company B, which means it connects company A with company B, which is money, right? So CAPM, which is the risk reward, and discounted cash flow. I've explained what this is, and I've explained the 1 plus R times. So it's like this. Let me recall this. It's cash flow for the year over 1 plus R to the power n. So 1 plus R times that. Discounted cash flow, and that's you keep adding over year and over, and then in IRR, it's the same equation. Sorry, IRR. It's the same thing, but except you have a initial investment plus, then you keep this repeating over and over and over and over. You keep adding in the middle like that. Okay, so next we have value at risk. This is easy. Hedging is of course balancing things out. If one loses, you want to make sure you get what I mean by hedging. So mergers, LBOs, I've explained what this is. Calls, you pick the phone up when you're calling, and you put the phone down when you're done with the call. So longing and shorting. Okay, shorting. This is the options trading, which is the share market. Okay, so you bet on either individual companies, or let's say Apple. Its ticker is AAPL, or you do index funds. Okay, index funds. So let's say Nasdaq, NQ. That's the index fund. All right. So VAR, which is simulate portfolio VAR. That's value at risk. This is just financial modeling. These are just packages. Don't worry about it. Mergers and acquisitions, budgeting project. Yeah, these are again practical projects, full financial model, just overall why a company should merge with company B, because it's worth it for the other company. You get what I mean? As you can see. So now, learning principles of a basic principle of finance. Master risk management, derivatives. Derivatives is like anything that makes you money. Anything that's supposed to give you a sort of a return on investment, pretty much. Okay. So what else? Behavioral finance. Yeah, everything else seems to be fine. Yeah. So have I missed anything here? I don't think I missed anything here. Yeah, inventory turnover. So how many times? So like inventory turnover, we have inventory turnover and asset turnover. So inventory turnover is like how many times a company's goods need to be replaced again and again because they keep running out of inventory. In other words, they keep selling their stock. Okay, see how many times a business sells and replaces inventory over a set period of time. Let's say in 1 week, okay, they run out of inventory. Okay, so let's say on day 2 they run out of inventory. So now, because they have had insane sales on that week, so now in that case, let's say plus, and then let's do happy face. And then what happens is by day 2, you need to now replace. Now, what usually takes 7 days, you need to replace it on day 2, and you need to restock. So that's called inventory turnover. Okay, asset turnover is a little different. So let me show you guys asset turnover. So it's a ratio of the company's total sales or revenue to its average assets. Okay, so let's say asset turnover is company's total sales over average as the revenue to its average assets. Sorry, average assets. So assets is of course something that makes them money, and how much they made as a how much they total made from those assets, pretty much, like with everything combined. So total sales is of course because of these assets as a part of it, right? So that's the asset turnover, as you can see. Okay, the ratio helps investors understand how effectively a company is running to use its assets to generate sales. Exactly, because if you want to get total sales, if your assets are doing you proper justice, then you will have good total sales, and that way you determine the asset turnover ratio. So then it indicates how well you're using your assets to make total sales. Okay, that's what this asset turnover ratio does. All right, so let's move on. Well, what else? So cost of goods sold over average inventory. That's for inventory turnover. The same thing for except total sales over the assets you have, average assets you have, and that's the asset turnover. Okay. So yeah, that's pretty much. This is the CAGR. Well, again, this is a little different. This is not enterprise value. This is investments ending value, investments beginning value, right? So this is a capital compound annual growth rate. Investment banking, once again, I've explained what this is. As you can see, raise capital, manage risks, mergers and acquisitions, initial public offering, that's going live on the stock market. And I'll get back to this later because it's a little complex. It's a Black-Scholes model. So again, this is the initial investment, okay? Initial investment, and then 1 plus R times N over so this is the initial investment, right? Total investment cost. And yeah. So the IRR, you see, it's the same equation as discounted cash flow, but you have the initial investment coming into play. That's C0 plus that's a cash flow towards the number of years over 1 plus R to the power, and let's call it 1 plus R times N. This applies in a lot of equations, so if you guys remember that, it's all good. Okay. All right. With that said, return on investment, I've explained this. Annuity is forever. Annuity, okay, forever. No, annuity is a guaranteed income, and perpetuity is forever guaranteed income. Okay, and that's annuity is guaranteed income, forever guaranteed income is perpetuity. All right, so with that being said, so that's net present value. All right, loan bond valuation. So bond is of course government bonds. Investment return. All right, so internal rate of return. Once again, I've explained this, how this works. Present value times 1 plus R times N. Yeah, so for now that should be enough. annual growth rate, future value over present value, to the power 1 over n minus 1. So let's take note of this one as well. Compound annual growth rate. Let's say compound annual growth rate. Compound annual growth rate, CAGR. And you can see the initial investment right here. So apart from that, we have EPS, which is earnings per share. This is a little different. So earnings per share is weighted a little bit different than so earnings per share, as you can see, net income, that's the total income minus preferred dividends. So that's how much you make from the investment. Weighted average number of shares outstanding. So a weighted average number of shares outstanding. So outstanding is public and private. Weighted average number of shares outstanding, right? Average number of shares outstanding. Net income is the total income minus preferred dividends, right? Earnings per share, okay. So accretion is when the EPS is higher, right? And dilution is when the EPS is lower. So price to earnings ratio is different from this. It's when share price over how much you make as a ratio, right? So as you can see, this is earnings per share, net income minus preference dividends. So let me grab this here. Preferred dividends, net income minus preferred dividends over average number of weighted average number of shares outstanding, right? So earnings per share, right? So it's the total income minus preferred dividends, right? Total income minus preferred dividends over weighted average number of shares outstanding. It's public and private. Right. So how much you make, right? How much you spend. Okay, how much you make, how much you spend, all you make minus how much you spend on stocks over how much you have invested in, right? Average number of shares outstanding, right? Right. Parable analysis. This is market multiples, traded income. Right. So with that out the way, so auditing is a process of exactly for like analyzing logs to ensure security, compliance, and interface suspicious behavior. Actuary balances risk to reward risk. This is what I was talking about. For the comparable analysis, we use this. Accounts payable, receivable, this is normal stuff. Model used to calculate the price of an option by simulating the possible price paths of the underlying asset over the lifetime of an option, right? Dividend, I've explained this. That debt, equity capital markets, and the debt capital markets and equity capital markets. That's what this is. That's what you need to extract from this. This is investment banking division coverage. So this is senior management. Those are managers pretty much. Merging and acquiring other companies. Sales and trading, equity research, asset management, brokerage. So this is capital markets. Mutual fund is exactly like how people pool money together to receive dividends. And like it's like it pools money into multiple different things. Like think of like a mutual unit trust funds. Those are mutual funds. Which are investment capital based on exactly. Income statement, that's gross profit, that's like per product. Okay, per product, this is how much gross profit. And then the net income, that's like after everything is taken away, like, you know, for paying employees. This is like gross profit is like per products, actually, not per product. Per products, this is how much you make. But then once you pay everything out, that's the total amount of money you make. So in this case, as you can see. So yeah, that's price to earnings ratio. That's we talked about this. Cognitive bias, unit trust funds. It's like a mutual fund in a way. A unit trust is a mutual fund. Unit trust is an unincorporated mutual fund structure that holds assets and provides profits to individual unit owners instead of reinvesting into the fund. Right. Yeah. Unit trust, which issues units representing diversified holdings rather than shares in the company itself. Right. Exactly. So it diversifies everything and has less risk, therefore. That's like the safest way to invest, honestly, unit trusts. So mutual fund is basically, unit trust is a type of mutual fund where it's the risk is like spread out because they have like experts have invested in a nice wide variety of investments, and those are the ones because it's so balanced out. That's why you make consistent, stable outcomes because it's not putting everything in one basket, like not putting all the existing eggs in one basket. So assets and liabilities, expenses, cash flow statement, capitalized pricing model, dividends, again, earnings before interest, taxes, depreciation, amortization. Yeah, counting the expenses, right? So you don't really need to like read fully through this. You can just like sort of skim it. 10K report is like a yearly, 10Q is quarterly, and 8K is bankruptcy. ROIC, yeah. Stock price, yeah, exactly. This is when there's supply and demand inconsistencies, you need to wait for it to balance theory, balance, and then efficient market is made again. Risk management, the process of, exactly. So hedging, diversification, yeah, reduce also make it from, yeah, exactly. Future value, that's present value times 1 plus R times 1. It's future value. Sensitivity table, exactly, as you can see. Average buyout, enterprise value, I've explained what this is. Total price to earnings ratio, I've explained what this is as well. Weighted average cost of capital, you guys can take a look at this. I have to, again, this is like how much a weighted average cost of capital is, like how much they spend for financing their assets. A company spends for financing their assets and debts, right? So to keep the operations running. So that's include like even liabilities, anything like employee salaries and stuff. So net sales over total average total assets, the turnover ratio. So it's like the total sales over like average total assets. So that way you can see how well they're using the assets. This is, let's say, econ turnover, asset turnover indicates how well is the company making use of their assets, average total assets, to make more money. That's average net sales. How well? So exactly. Return on assets, exactly. Return on equity, that's like, you know, holding equity is like a percentage of a company. Assets is like, you know, like actual, everything is an asset if you think about it. Like how well things that it owns brings in money. That's a return on assets. I'll explain this. I mean, I went through this. GDP nominal is like gross domestic product is like how much buying and selling happen in a certain economy to make it money, right? So final outcome of money of the goods and services bought by people produced in a certain country in a given period of time. Exactly. So in a certain country, how much buying and selling happened, and how much was bought during that certain period of time. Nominal is in the name only, and this is the real GDP. That's why it's like, you know, this is like an average, a mean. Again, derivatives, I've explained this. Income statement, you know, revenue, expenses, net is once total, right? Like once everything is done, that's when it comes to the net. So think of it like that. Once the income and the debt is paid off, you come to the net. So as you can see, cash flow. So we've explained this. Time value of money, 1 plus R times N. It's Excel. Balance sheet, exactly. Discounted cash flows and stuff. Growth rates, margins, yeah. So everything is always like the final growth rate over the initial invested times 100. Depreciation, liabilities, equity, so how much you owe, what you own. Assets is liabilities, what you owe versus what you own, right? Learn discounted cash flow. We've done this comparable analysis. Once again, precedent transactional, precedent transaction analysis report. That's exactly. You've done that. Price to earnings. I've done this. I explained to you guys what this is. Buy side, sell side, accretion, dilution. Yes, mergers and acquisitions. So this is when the EPS, earnings per share, is going up. The earnings per share is high. Dilution is when the earnings per share is low. So when you're trying to merge, pitch to another company that this is a good. So that's when you're done with precedent transaction analysis. That's the, in other words, comparable. How you do this is through this sheet. Exactly. So yes, we're done with this part. You can see that we have the return on investment capital. Ticker, that's how you pull the data. 10K report, that's a yearly. It's got a cash flow, leverage buyouts, comparable company. Exactly. So this is income sheets, balance sheets, and income cash flows, pretty much. What else? Yeah. Right. Cool. This is once again just how you do the comparable analysis. It's on this chart. I've explained what this is over and over. See, EBITDA, earnings before interest, taxes, depreciation, and amortization. This is sales and depreciation and amortization. You also have interest and taxes only, earnings before interest and taxes only, and then we have price to earnings ratio at the end in a kind of usual precedent transaction analysis. As you can see right here. So that's the average and the median, 75%. So depending on the need, you actually do that. So boom, finalize values. That's how you understand how a company is doing. It's an extensive view on that. As you can see, market capitalization, enterprise value, sales are, you get the point. Hedge funds, again, pretty simple stuff. Global macro, it's like the whole world, what's happening. So how in the form of function events, like I mean, like in this case it will be like Iran and what's Israel fighting, how it impacts the stock market, for example. Quantitative arbitrage, just buying in differences in orders, capitalizing off them. Diversification, exactly. Yes. Exactly. So this is the three statements. And this is Excel work. Cash flow, yep. Yes, okay, discount rate. Leverage buyout, yes. Accretion dilution, yes. Leverage buyout. Margin and acquiring, earnings per share. Price per, that's like earnings per share. Okay, let's do this now. Randomly recall. EPS is equal to net income. Okay, net income minus preferred dividends. That means preferred stocks you've invested in. Let's think of it like that. And we're over weighted average invested capital. I think in weighted average the return on assets, right? Return on assets. So net income minus preferred dividends over average common stockholders. Okay, let me think. Average common stockholders equity, right? So let's go for average common stockholders equity. Average number of outstanding shares, so that's private and public. So earnings per share, weighted average number of shares outstanding. So let's take note of that. Earnings per, yeah, just remember it as EPS. EPS, earnings per share. The net income minus preferred dividends, what you prefer to invest in, divided by weighted average. So we call it weighted average number of shares outstanding. Private and public. Cool. Let's move on. Internal rate of return. Cool. Average buyout. Yes. This is the initial investment once again. LBO. Forecasting methods, again, as you can see. Time series, that's a regression chart. Any type of, it's like a not a logistic regression, but it's a regression chart. This fiscal is government, and monetary central banks. Value at risk. This is standard deviation. How spread out values are from the mean towards a negative, towards a positive. It's how you calculate actuary work. Data modeling. Yeah, this is what we've explained. This is corporate restructuring. So as you can see, equity and debt. So what you own versus what you owe. I'm gonna say, that's a part of management. Exactly. So quantitative is math, quantitative is facts, right? Time series, once again, logistic graph with regression chart. This is a indicating that it's impossible to assume that the prices can be predicted, right? So efficient market hypothesis predicts that this assumes the market cannot be predicted. This future share cannot be predicted exactly based on previous price moves. Exactly. It's like the efficiency theory. Accruals is sort of accounting, right? So everything is accruals, and so this is assets, liabilities. What's the total? So net is like once both of them are calculated, assets minus liabilities. In this case, it's 0. Discounted cash flow. Valuation method used to estimate the value of an investment based on its expected future cash flows. This DCF analysis attempts to figure out the value of an investment today based on projections of how much money it will generate in the future. Right? So today is a discount, and in X amount of years, it's going to make this kind of money. Today is a discount. In X amount of years, it's going to make more money. Is DCF? Yes. Interest rate used to when calculating percent value of the investment, right? Let's get that definition as well. Interest rate used when calculating net present value of the investment, right? Let's see what GPT has to say. In the meantime, discounted cash flows. Once again, we've done this. I don't know about that. We'll do this later. Right, this is a payment formula. So capital asset risk to reward, pretty much, right? This is a risk to reward. That's the point of this. Internal rate of return. Time value of money, I've explained this. Fiscal is government. Central banks monetary. These are career paths. Yeah, that's it. And economic cycles, pretty much. Expanding, peak, top of the right. Contraction, things are going down. Trough, lowest point. So it's going up at the top. Expanding, going up. Top is to the peak. Contraction is going down. Contracting, going down. And then trough is the lowest point. Exactly. I mean, if you make X in the future, how much is it worth today? Exactly. Exactly. Okay, that's it for this video, guys. Hope you guys enjoyed. Thank you so much for watching, and I'll see you guys in my next one. Bye bye.